Hello analysts, and welcome to the 360 Huntington Funds video series on equity valuations. In this video, I'll be showing you how to retrieve and input the balance sheet into your valuation model, as well as cover some basic concepts that you should be familiar with. Please keep in mind that additional information on importing the financial statements can be found within the course packet that is available to all registered analysts through Blackboard. Let's get started. So if you have your valuation model already set up, you'll click on the BS tab, stands for balance sheet, and we brought to a screen that looks like this. On the balance sheet, you'll notice that it's assets, liabilities, and shareholders' equity, or stockholders' equity. That's covered here. So first, what you're going to want to do is open up Morningstar, enter in the ticker symbol of the company you're looking to do. Click on Financials, and then click on Balance Sheet. You're going to want to make sure that they're in ascending order, 5-year period. Make sure the rounding is consistent with your income statement. Make sure it's annual. And then you're going to click Export. You're going to download the balance sheet off of Morningstar. And it's going to look something like this. So now that you have this available, you're going to copy this information into your valuation model. Into the appropriate areas of assets, liabilities, and shareholders' equity. So let me just start by discussing a couple of things about the balance sheet. So the first thing you'll notice is that current assets is at the top. Current assets are all assets that an entity should could readily convert to cash in order to pay outstanding debts and cover liabilities without having to sell fixed assets like a piece of property or equipment that the company uses to produce income. You see cash, accounts receivable, inventories, deferred income taxes, prepaid expenses, but yours may vary slightly from what's seen here. Then you'll see non-current assets, which is a company's long-term investments, things like property, plant, and equipment, or PP&E, as well as goodwill, intangibles, and some other line items as well. Now, I want to point out quickly specific line items here of goodwill and intangible assets. These will play a role in the valuation models for price to tangible book value. Goodwill is an intangible asset, meaning that it isn't a physical asset like a company's property or equipment. It comes from an acquisition of one company by another for a premium value. The value of the acquired company's brand name, good customer and employee relations, as well as any patents or proprietary technology is what is ultimately represented as goodwill on the balance sheet. With regard to intangible assets, the intangible assets line item is essentially the same thing as goodwill, but instead of the value being derived from an acquisition of another company, it originates from the company that you're actually evaluating. So further down, you'll see current liabilities right here. And current liabilities are a company's debts or obligations that are due within 1 year. Current liabilities appear on a company's balance sheet and include short-term debt, accounts payable, accrued liabilities, and other debts. A little further down, you'll see non-current liabilities. And those are a business's long-term financial obligations that are not due within the present accounting year. Examples of non-current liabilities include things like long-term borrowings, bonds payable, and long-term lease obligations. Down here is shareholders' equity. Now, shareholders' equity is a firm's total assets minus its total liabilities. It comes from two main sources. The first is the money that was originally invested in the company, along with any additional investments made thereafter. The second comes from retained earnings, which the company is able to accumulate over time through doing operations. So now further down, you're going to see this area of variables for relative historical models, as well as the variables for free cash flow to firm model. So there are a couple of things that you're going to have to forecast here. And for the sake of time, let's say I've already imported and placed all of the information into the balance sheet. Okay. So the first thing you're going to want to look at here is total equity growth rate. You're going to need this to figure out the percentage of total equity that is goodwill and intangible assets, which will ultimately lead you to your tangible book value per share. So you'll see that the total equity growth rate is equal to that particular year minus the year before, divided by the year before, and that just gives you the growth rate from year to year. You'll see that there's different growth rates from year to year. You can use a rough average or input something that you feel is appropriate based on your research. So for this, I chose 27%. Not for any particular reason, this is just an example. So then you'll move down to book value per share. Now, book value per share is the total shareholders' equity divided by the diluted shares outstanding. So you see here, there's the shareholders' equity, and it's linked to the balance or the income statement to the diluted shares outstanding. You're going to want to keep these formulas consistent. However, you may need to reference an unedited version of the valuation template alongside what you're doing, just so that you can keep these formulas consistent. So now further down, you're going to be looking at goodwill as a percentage of total equity. Now this isn't specifically the way that a common form of balance sheet is actually done. Usually it's a percentage of total assets, but for this we're going to be using a simpler version in terms of goodwill as a percentage of total equity instead. So for this, it is that particular year's goodwill divided by the total equity. Now, this you're going to use in order to forecast the coming year's goodwill and intangible assets. Now, if you know that a company is going to be, or if a company has, your company has purchased another company through an acquisition, you may have some justification as to increasing goodwill as a percentage of total liability. But this, again, is just an example, so it's something that you're going to need to consider. So you can look at what the percentage of goodwill is to total equity here. This input changes this figure here. You can see it's linked to this input. So when you change this input, when you change the input, it changes the value up top. Now the same thing with the intangible assets as a percentage of equity. And then from there, you're going to derive the tangible book value per share. So the tangible book value is simply the total equity, subtract the goodwill, subtract the intangible assets, divided by the diluted shares outstanding. And the reason that we do these two things will be covered in the historical price to book and price to tangible book models, but they're important for you to understand here in terms of the mathematical calculation that goes into it. Further down, you're going to need the variables for the free cash flow to firm model. It's just one for this particular financial statement, and it's the working capital as a percentage of sales. Now, working capital is normally defined as the difference between the current assets and current liabilities, and indicates whether a company has enough short-term assets to cover its short-term debt. For valuation purposes, we have to negate a few of these items from both the assets and liability side of the equation. So you'll see that there's a note giving you the equation itself. And when you break this down, it ultimately comes to current assets minus the cash and short-term investments, and then you subtract the short-term debt from the current liabilities, and then you get your modified working capital. Now, the reason that we do this is because cash, in many cases, is invested by firms in treasury bills, short-term government securities, or commercial paper, And while the return on these investments may be lower than what the firm may make on actual investments, they represent a fair return for riskless investments. This is in contrast to things like inventory, accounts receivable, and other current assets. And this is why we don't include those items in the measure of working capital. On the liability side, like I said, we remove the short-term debt, and this debt comes back into play during the free cash flow to firm model and would be inappropriate to count twice. So you can see here, based on the modified working capital, and then you get change in working capital as a percentage of sales, and that's the variable that we're going to need for the free cash flow to firm model. Now, in a lot of cases, you are going to see this fluctuate pretty wildly, and you may see changes as negative 30% one year and then positive 30% another. And the notion here is that over the long term, it typically will even out to zero, but that will be covered more in the free cash flow to firm model. So at this point, you should understand, for the most part, what you need to do for the balance sheet, what you're going to need to forecast and understand. If the year that you're working in, so 2014 at the time of this video, not all the information is available currently. So what you can do is you can break down the quarterly balance sheet and get some information about each one of them and forecast the fourth quarter or unreported quarters based on the historical information. But for the most part, what you're really going to need to focus on here are the goodwill and intangibles, shareholders' equity, as well as the inputs for cash, short-term investments, and short-term debt for the modified working capital equation. This concludes the video on balance sheets. Please look into the cash flow statement video as